Imagine you were 20 years old and every single month you put aside just $100. Not a huge amount, just $100, and you kept doing it every month for 30 years. You never checked the account. You never tried to time the market. You just let it sit. Today, you just turned 50. Here's what that account is actually worth. $226,000 from $100 a month. No stock picking, no trading, no luck involved. And here's the part that surprises most people. Less than $36,000 of that was actually your money. The other $190,000? That's not from working harder or saving more. That's from something called compound interest. And once you understand how it actually works, you'll never look at saving money the same way again. So let's break it down. Compound interest is simple. You earn interest not just on the money you put in, but on the interest you already earned. It's like a snowball rolling downhill. It starts small, but the longer it rolls, the faster it grows. In year 1, your $100 a month barely earns anything. By year 20, that interest is earning its own interest, which is earning its own interest, and the growth starts to explode. This is why the earlier you start, the more powerful this effect becomes. Time isn't just a factor. It's the most important ingredient. To prove it, let's compare 3 people. Same $100 a month, same 10% average return. The only difference between them? When they started. Person A starts at age 20, person B starts at age 30, person C waits until age 40. All 3 invest $100 a month every month until they turn 50. Person A invests for 30 years, person B invests for 20 years, person C invests for just 10 years. In total dollars put in, person A contributed $36,000. Person B contributed $24,000. Person C contributed $12,000. A noticeable gap, but nothing dramatic. Each one simply put in $12,000 less than the one before. Here's where it gets interesting. At age 50, person A's account is worth $226,000. Person B's account, about $76,000. And person C, who waited until 40, around $20,500. Look at that gap again. Person A put in 3 times more money than person C, but person A's account isn't 3 times bigger. It's over 10 times bigger. That's not a coincidence, and it's not because person A was smarter or luckier. It's because compound interest rewards one thing above everything else: time. Not effort, not timing the market, not picking the right stock, just time. This is the single biggest reason financial advisors always say the same thing: start now, even if it's small. Especially if it's small, because $100 a month feels small today. But 30 years from now, that $100 isn't just $100 anymore. It's a piece of a $226,000 puzzle you built without even noticing. So if this math is so simple, why doesn't everyone do it? I looked into it, and there are 3 real reasons. Reason 1, $100 a month feels too small to matter. So people wait until they have more money to start. Someone tells themselves they'll start investing once they get a raise, or once they pay off a credit card, or once things feel more stable. And that wait quietly turns into 1 year, then 5, then the 10 years that separated person A from person B. In our example, the 10 years that were worth $150,000. Reason 2, market drops scare people into stopping. Someone starts investing, the market drops 20% 6 months later, and it feels like proof that this doesn't work. So they pull their money out and lock in the loss right before the recovery. But the math we just showed you already assumes an average return, and that average includes the bad years. The 10% figure isn't what happens every year. It's what tends to happen if you stay in long enough for the bad years and the good years to balance out. Reason 3, and this is the big one, nobody makes it feel real. $226,000 sounds abstract, like a lottery number. It doesn't feel connected to the $100 you're not spending on takeout this week. Your brain is wired to care about what happens this month, not what happens in 2056. So the small decision loses to the big number every time, even though the small decision is the only thing that actually creates the big number. That disconnect between a small decision today and a massive result decades from now is exactly why most people underestimate what they're capable of building. So now that you understand why the math works and why most people miss it, let's talk about how you'd actually put this into practice. You don't need to pick individual stocks to get this kind of result. The $226,000 example we've been using is based on the historical average return of the S&P 500, which is essentially a basket of the 500 largest companies in the US bundled into one investment. A lot of people build the core of their long-term investing around a low-cost index fund that tracks something like this, precisely because it doesn't require predicting which single company will win. You're not betting on one company, you're betting on the market as a whole continuing to grow over decades, which is a very different and historically much safer bet. Step 1. You don't need $226,000 worth of confidence to start. You need $100. That's it. That's the entire barrier to entry. Step 2. Automate it. Set up an automatic monthly transfer into your investment account the same way you'd set up a bill payment. The moment you have to manually decide every single month, you'll eventually skip a month, then 2, then it's gone. Step 3. Don't check it every day. We showed you the average includes down years. Checking daily just tempts you to panic and pull out at the worst possible time, the same mistake we talked about in reason 2. And step 4, the one nobody wants to hear. Time is the one variable you can't buy back. You can always find more money later. You can never find more time. Whether you're 20, 30, or 40 right now, the best time to start was years ago. The second best time is today. So if this video did one thing, I hope it's this. Made $100 feel less like a small amount and more like the first step in a 30-year snowball. If you want to see exactly how compound interest applies to your own numbers, your age, your monthly amount, I break down the exact formula in the next video. For now, if this changed how you think about even $100 a month, hit subscribe. I'm breaking down one real money concept like this every week. And drop a comment. Would you rather start with $100 a month at 20 or wait and invest more later? Because the truth is, the number isn't really $226,000. It's whatever version of that number you decide to start building starting today.